All right, welcome to Talk Tickers. Today, we're digging into Haverty's second quarter 2025 earnings. And look, on the surface, it seemed like a quarter of solid wins, but the way the market reacted, well, that tells a much more complicated story. So let's get right into it. Haverty's reported numbers that just blew past what Wall Street was expecting. But instead of a big rally, the stock actually took a hit. That's the puzzle we're going to solve today by looking past those shiny headlines and into the nitty-gritty details that traders were really paying attention to.
Okay, first things first, let's do a quick rundown of the big headline numbers. And honestly, if you only looked at these, you'd be thinking, wow, Haverty's had a stellar quarter. They even broke a pretty long-running negative trend.
Now, a 1.3% sales growth year over year. I know, it might not sound like a massive jump, but for Haverty's, this is a huge deal. We're talking about the company's first quarter of positive growth in almost 3 years. It broke a really long losing streak that started way back in late 2022.
And they didn't just grow, they totally beat expectations. Revenue came in at over $181 million. That's almost $4 million higher than what analysts were predicting. You know, in this tough retail world, beating your top-line forecast by that much, that's a definite positive.
And the good news kept rolling on the bottom line, too. GAAP earnings per share, or EPS, hit 16 cents, which also topped what everyone was expecting. This kind of tells you that the company's being pretty disciplined with its costs and pricing. So you've got a beat on revenue, a beat on earnings. What's not to like, right? Well, here's the twist in the story. Even with all that good news, the stock actually finished the day down over 3%, and on heavy trading volume, too. That's a clear signal that the market was digging deeper, and it didn't like everything it was seeing under the hood. So this is where it gets really important to understand what investors were actually weighing. Yeah, the positive headlines were one thing, but the operational numbers and rising costs, they were painting a much murkier picture.
And this slide really gets to the heart of that whole conflict. On the one hand, you've got the awesome return to top-line growth and really strong gross margins holding steady at nearly 61%. But on the other hand, there are these worrying signals coming from their core stores and these creeping operational costs that are just eating away at profits.
All right, let's really break this down because this is probably the most important part. Total sales were up 1.3%, sure, but that growth was mostly coming from new stores they opened. The really critical number for retailers' health, what we call comparable store sales or comps, was actually down 2.3%. That means the existing established stores are still struggling, and for investors, that is a major red flag. The other big headache for the quarter was SG&A. Think of this as all the costs of just keeping the lights on, advertising, rent, salaries, all that stuff. Well, those expenses grew to 59.3% of sales, and when your running costs are growing faster than your sales, that's a direct hit to your profit margins. No way around it.
Okay, so now let's pivot and look at how management is planning to deal with all this. The earnings call gave us a really clear window into their game plan for navigating what is, let's face it, a tough consumer environment and rising costs. You got to give credit to the CEO, Steve Rool. He didn't try to dance around the main problem. This quote right here shows he's looking the weak comp sales number right in the eye. They know that getting those existing stores back to growth has to be priority number one.
So what's the actual plan? Well, a few key things came out. First, they're getting ready to adjust prices to handle potential tariffs and protect those strong gross margins. Second, they're hitting the brakes a little on expansion, pushing some new store openings out to 2026 to hold on to cash. Third, to get people back in the door, they're actually upping their marketing spend. And finally, they're leaning on their incredible debt-free balance sheet. It's like a fortress, which gives them a ton of flexibility to make these moves without getting into financial trouble.
All right, so let's pull all of this together. We've got the headline beats, the concerns hiding underneath, and management strategy. So here is our forward-looking take on Haverty's. Here at Talk Tickers, we're giving Haverty's a market perform rating. Now, this isn't us telling you to buy or sell. It's really just a reflection of the balanced reality here. There's real, tangible progress with that return to sales growth, but at the same time, it's being pushed up against some very real economic risks and operational pressures.
And this table here lays out that whole debate perfectly. The bull case, the argument for the stock, is pretty straightforward. Sales growth is back, those gross margins look great, and the company has zero debt. Can't argue with that. But the bear case is just as compelling. Comparable store sales are in the red, those SG&A costs are climbing, and let's be honest, the housing market is a huge headwind for any furniture company right now.
So what does this all boil down to?
It really leaves us with the critical question that's going to define how the stock performs over the next few quarters. Look, Haverty's is doing a great job on the things it can actually control, like merchandising and keeping costs in line. But is that enough? Is it enough to win a fight against the soft housing market, shaky consumer confidence, and all this tariff uncertainty? The answer to that question is going to tell us if this quarter was a real turning point or just a temporary bright spot.
And that wraps up our deep dive into Haverty's quarter. As always, remember, this is not financial advice.